Hey guys, so welcome to not another episode of Price Targets because it's been, I don't know, 2 years, but we're gonna be doing a quick recap of what I'm seeing and don't expect these to regularly occur again. I just found my old settings for Streamlabs again, so we'll just do a quickie. So I want to point out one important thing when it comes to Bitcoin. It's we have boonk. This is a pretty sideways correction. I'd say that qualifies as a wave two, and then this one is definitely a bit steeper to the downside. So very well may actually qualify as a wave four, right? It could potentially be the case that somewhere in here there is a fifth, and then this is the steep correction. So that puts us at a five in the making, which begs the question: do we continue from here or not? If we consider, and we'll go to that chart in a bit, the S&P 500. That looks very exhausted, and then we are going into what is a very tricky period with the transition into Trump's second term. The Biden administration has been very, 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 I don't know. It seems to me manipulative of the data in trying to kind of favor the voting for in their favor. So I don't know how good is the economy doing. And then the other thing, so the S&P 500, keep that in mind. And the other thing is that I want to look at the rates. Essentially, what I've been seeing is that since we started cutting rates, the long end, so like the 10-year or the 30-year, has been vamping up again. And the theory here is that if you're going to cut on the in the short term and the long term goes up, it's because the long term expects that inflation in the long term is going up. So they demand a higher price for lending you money for that period of time, right? So essentially what the market is saying there is it is impossible to get out of the problem that you have. If you cut on the short term, you're going to raise inflation on the long term. But nobody wants to take the brunt of the force of raising too much right now, creating a problem. With that said, it seems that the Federal Reserve was way more aligned with the Biden administration and the globalists, which begs the question what's going to happen once Trump takes office. Okay, so a lot of words there, but I think that's good to keep in the back of our minds. Now, I want to point out something else. Go here, December 2017, and go here, right? So I'll get it down to the daily. Move this over here, December 17, 2017, right? December 17, 2024. That's a 7-year cycle. If anyone's into GAN, you know how important the 7-year cycle is, or the 49-year cycle, or, multiply it how many times you want. That is significant. The other thing I love to look at is just, how does it compare actually in terms of not absolute price action, but do we have like similar points of time? So this can be, I don't know, 50% and then up again. That might be 20% in today's price action. But do we have like similar moments in time of, so do we follow a similar kind of price action? It doesn't have to like keep on going like that forever, but initially, I love to check whether these cycles align, especially when before like you actually think there might be something happening there. So this is interesting. Let's go and look. We just notice that we haven't adjusted the time. Okay. So we put that there, and then we add another little marker here, which helps us to keep the time aligned. And bam. You see how we're basically almost nearly onto the same pattern. Bottom here, high here, bottom here, high here. We sell off into have a little kind of pause. So whatever's happening here, we might be very much copying or following that rhythm for whatever reason. If you're into Gan, you know that these are important to follow. So I don't know whether the expansion of this pattern, let me remove that. I don't know if the expansion of this pattern will lead to the exact this expansion that we've seen in 2017, but generally speaking, this looks like a Head and Shoulders, and just give half a bit of a price here. Generally speaking, you break down like the 0.382 or half of it, and you do like a double expansion somewhere in between. So that puts you into, this area. There's a gap here where price really accelerated really fast. There's a bit of a consolidation here. So if this breaks down, that's the area where you start looking. There's a little bit of the wick here at 85. It's probably gonna break below that if this structure breaks down, and it kind of starts to really look like that. You notice that we talked about essentially Friday was a very shitty day where I really wanted to see the price break out, and I thought, okay, well, maybe we got suppressed by some fucking reason on Friday. So, let's see if the market is going to do anything in the weekend. And then I said, well, if come Sunday, end of Sunday, we don't see anything happening, that's just, and essentially it pumped a little on the open and then it's just straight down again. So fuck that. So we're looking to do a correction on the pump we've had since August, September into now. So that's the first level of interest right there. And then I love to, if this is a serious, if this is going to be like a longer drawn out correction on Bitcoin, I love to take notice of the fact that these generally happen in thirds. So take the third. This can be the tricky part, but you notice how this is like the first. No, let me put it differently. So this is the top third, the second third, and that's the third. You generally get into the second third, and then either you leave upwards or there's a capitulation event into the third third. So if we're going to see a long drawn out correction here, I expect to get into the second third. We use the first third to kind of mark the bottom here. Maybe we get into, for example, the weekly, and we use the weekly closes here, kind of like that, to structure it. So that puts us at, Actually, right inside that little daily point here. So the wick here on the daily into this area. And that's probably where you, if you're going to break this down, where you can expect this time pivot here to work out to the upside. So bottom, relief rally into, I'd say probably a maximum of this area, right? Oh, coffee. So that said, that's the kind of view if this breaks down, and I think that's what's going to happen. I can be wrong. We go to the S&P 500, which kind of shows you the same. We can use the SPX. Let's just use the index. I think the futures contract is a little bit wonky because so essentially this kind of pattern, maybe you got to draw it a bit like this, where you had a little fake out here and then try to fake out there. So this is balanced, and then this seems to be breaking down. We'll see today how that fares. It's the index is closed off obviously right now, but futures are trading lower. Let's see. Yeah, futures are trading lower, which is not really, can't really use that because there's not much volume there. But essentially, this is indicative of this pattern. So this is breaking down. This is what looks like an ending diagonal, and then in the bigger scheme of it, look at like this is, I'd say this is a full completed wave. There's a bit of a pause here, and then 1, 2, 3, 4, 5. So maybe we get a correction here and then another run up, or maybe this is like a fully completed wave. I don't know. With Trump entering office, it's going to be tricky because I think a lot of the things he's going to do are actually beneficial to the economy long term, but I think he's also going to uncover a lot of manipulated data to skew everything in the Biden administration's favor. We'll see how that works out. And then the other thing that's just, the long-term treasury bonds, it's just looking horrendously bad, right? Yeah, so let's scrap the overnight funding rate. And this is essentially when they started cutting, the long-term rate started to go up. This is like this going down here means the long-term rate is going up. I can show you this by the US 10 yield. Let's grab the US 10 yield. No, sorry, my bad. All right. Bam. So the cutting starts. Purple is the US 10 yield inverted. This is the overnight secured funding rate in red-ish. And then you see how these are practically the same, right? So that's a problem. Like, If Donald Trump gets his way, he's obviously gonna cut further to stimulate the economy, but it's also going to drive the long-term rates higher. This is a zero-sum game. I think you have to see it this way. You have a problem and you're trying to manipulate. Like you have a racing game back in the days where you have to choose between grip, speed, maneuverability, whatever. And then all those sliders and you can move them around, but you always, you always end up in the trilemma, so to say, where you choose speed and then you have less grip and then less maneuverability, etc., or the other way around. If Trump goes the other way, if he has any influence on it at all, where you go super tight on the monetary policy, which will alleviate the long-term rates and will bring them down, obviously. But then you're going to have a lot of pain on the short term because rates go down. So credit will freeze entirely. Essentially, what they're saying is that you have a problem and you got to grow your way out of it. And there is no real solution to it. Like you kick the can down the road and maybe you will manage to do it this time again and it causes like huge inflation. So there's no ideal outcome here, but we don't know exactly what the outcome will be either. But this is very important to note. This brings us to, I think, the dollar. But first of all, like pushing the long-term rates up is a giant problem for all these banks because obviously they own a ton of the long-term treasuries because the Fed told them to start buying that shit since 2008, and the Fed actually bought it too. So everyone's like profiting out of this fake money kind of phenomenon, which helped the economy thrive in this, well, thrive. But there's so many losses on these books. So like, are we able to kind of circumvent that? I don't know. So that's one thing. And then the other thing is the dollar is absolutely, let's remove that. There's a certain fractal that I'm using for this. But essentially this is a giant reaccumulation. I always pick the wrong one here. So a giant reaccumulation. And this was your spring. This is going, like, in my opinion, this is going way, way higher. 120 easily. Nice IP address there. Luckily, that's my VPN. Fuck that shit. That's the annoying part about TradingView. Like they started to like you used to be able to kind of use it on multiple devices at the same time without it like one device locking you out of the other one. They've changed it and they use like this fucking stupid excuse where data providers only allow like one connection, whatever, at the time, but then they apply it to all of their data feeds, which is kind of ridiculous because these data feeds don't all require it. It's just a few like CME and a bunch of other like legacy TradFi bullshitters. Anyways, this is reaccumulation. It could obviously like be the opposite, but I've seen this pattern, and essentially what you do is you work your way out of it like that. And that's problematic because obviously the dollar index is a representation or a basket with that's heavily skewed towards euro, but that's no excuse to, for example, not be aware of what's happening here, because it's all moving in the same direction. So we've been talking about this chart a long time. Japan is the biggest foreign holder of US treasuries, and they will have to protect their economy and their central bank system. So there's a lot of treasuries to be sold here, especially long-term treasuries, if this goes higher. And I don't think they can keep the lock on it. Like 30 years of an experiment of modern money theory is it's tricky, and it's the same fucking pattern. It's ridiculous. Oh shit. It's just a giant reaccumulation pattern. Swept the lows, started to break out. This is a bubble about to burst. So all of that put together, this I've been talking about this for 2 years. So boy cries wolf. That's for sure. But let's go back to this one. I think we have a pause on our hands here, and we're gonna be visiting these lower levels, and it will very much depend on what happens in TradFi, how low we go. It could very well be that this becomes like a drawn out kind of bouncy area into I think the TradFi, like S&P 500, has a giant volatility event into August, around August, July, August. So around here, maybe you have a giant liquidation event here, and then you go up. In terms of the S&P 500, I don't know exactly if August then will actually be the bottom, or that will just be a relief rally into more pain later. Because S&P 500 is outside of any boundaries that you can model it with for the last 130 years or something. So incredibly complex stuff there. I do believe that Bitcoin is the fastest horse. So if anything bad happens, it will be relatively short on Bitcoin compared to TradFi. And you can see that, for example, with gold in some of the major crises. It definitely always got hurt in terms of, their liquidity wave, or the lack of liquidity would always hurt the asset price short term. But it would find a bottom and find its feed like way earlier, and then generally outperform much earlier. I guess that would be the case for Bitcoin in case we have a liquidity event in the next 6 months. We'll see if that's or the next 7 months. And I think that's it. That was a lot of rambling. 23 minutes. Hope you enjoyed that, and don't get used to them, because literally not going to do many of these as it stands. And I'll maybe talk to you guys later. Peace.